WTI rebounded from its recent plunge near the 81 level this week, climbing the 85 per barrel range earlier today as the EIA and API crude oil inventories reported unexpected falls beyond market expectation. Nonetheless, oil traders are dealing with conflicting fundamentals as the US unravels its plan to sell oil from its strategic petroleum reserves, the looming OPEC supply cuts in November, the decision from the EU to ban Russian oil, and the deteriorating demand outlook from China. Furthermore, aggressive monetary policy tightening and growing fears for a potential global economic recession inject additional uncertainty in this equation. In this report, we aim to shed light on the catalysts driving WTI's price, assess its future outlook, and conclude with a technical analysis. On Wednesday, US President Joe Biden unveiled plans to sell 15 million barrels of oil from the strategic petroleum reserve, aiming to bring oil prices down to an acceptable level in an attempt to relieve some pain of the consumer front ahead of the upcoming midterm elections in November. In this speech, President Biden noted, "We're going to continue to stabilize markets and decrease the prices at a time when the actions of other countries have caused such volatility," pointing towards Russia's invasion in Ukraine as a responsible culprit for the spike of energy prices this year. Moreover, the decision is seen as an attempt to counteract the recent 2 million barrel supply cut announcement from OPEC, set to take effect in November. Since the cut pointed to a divergence of fundamentals and market pricing of the commodity, sending oil prices in an upward spiral during the past week. Nevertheless, the recent move acts as another feisty exchange between the US and Saudi Arabia, and their relationship appears to be turning sour according to analysts. Lastly, the plan entails the repurchase of oil from the markets at cheaper price in the future, should that be an option. Amos Hochstein, White House senior energy advisor, in Bloomberg interview yesterday, cited that $70 per barrel is the ideal level the government eyes for repurchases, with the goal being to replenish the entire SPR stockpile within the next few years, but also to provide incentives for big oil companies to invest in production domestically. On another note, the US crude oil inventories pointed to an increase in oil demand during the past week, as the EIA yesterday reported an unexpected fall of minus 1.725 million barrels in inventories, despite expectation for a build-up of 1.380 million barrels. Furthermore, the API weekly crude oil inventories figure reported on Tuesday also unexpectedly fell by minus 1.270 million barrels for the same period. Moreover, we would note that last Friday the Baker Hughes oil rig count showed that the number of active oil rigs in the US has risen by 8, reaching a total of 610, which could be another indication of increased demand levels, matching the upwards trajectory of oil prices observed this week. During the 8th round of sanctions targeting Russia crude oil, the European Commission stated that it would impose shipping restriction should an oil tanker transport oil above the agreed price threshold, indirectly forcing the ship owners to comply with the G7 price cap agreement, warning that their ships will be prohibited from obtaining EU services related to the shipping of the commodity. The decision follows suit after the escalation of the war in Ukraine and is seen as another counter-offensive measure at restricting revenues arising from oil flowing back to Russia, which are used to finance the prolonging of the war. Also worth mentioning is that the European Union's embargo on Russian oil is to take effect in December. Thank you for watching.